Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 17th of May 2020. And yesterday we published our gold and silver weekly update for the week ending the 15th of May, where we highlighted the last week. Gold rose $40 an ounce to $1,743 and silver rose $1.14 to $16.66. We also pointed out that gold closed at a 7.5-year high in US dollar terms, although in numerous other currencies it had reached all-time highs at least twice in that week. Now, since the start of this year, we have stated that this will be the decade for gold and silver prices, where we shall see all-time highs being easily surpassed. We also pointed out that such rises would be more gradual rather than an overnight revaluation, and that the economic conditions were such that we would see a number of dips, but the overall trend line would rise, or would be up. Based on what we knew in January, our best estimation and calculation was that stocks would perform well in a US election year, as the China-US relations improved and the Trump administration would ensure that adequate liquidity and spending measures would be such that continued economic growth, at least into 2021, would assure his victory at the polls in November. This would have meant that the Dow would have exceeded 30,000, and it came very close to it. Equity markets across the board reaching all-time highs. Gold remaining a little subdued but holding firm, with its uptake to occur really at a rate in late 2021 and 2022 and beyond, as the election euphoria died down, and the economy having to pay for the stimulus injected into it by means of inflation and to some degree currency devaluation, and of course other investment market corrections. Now, unknown to most, the recent pandemic was lurking in the shadows, and de facto certainly changed the economic environment or landscape, with central banks around the world undertaking to do, quote, whatever it takes, unquote, measures, and helicopter money being delivered to citizens. It is more than likely that our original vision of how 2021, 22 and 23 would pan out in relation to gold, and thereafter silver, would be speeded up somewhat. There were many constraints limiting gold's advance, including a strong dollar, competitor investments such as equities, bonds, and even to some extent cryptocurrencies, and not least of which, relatively lackluster physical investment demand at that time. Now, that said, since mid-March the environment began to change quite significantly, with investment houses, banks, and a whole array of advisors now seriously suggesting that gold should be the investment of choice, if not necessity. Now, those who follow this channel will be more than aware from our previous videos that investment advisors were changing their positions, albeit slowly and tentatively, on gold as long as 10 months ago, but it has certainly gained pace more recently. Let's take a look at an FT article published in mid-March first, and we then have two other more recent articles to look at after it. Financial Times article dated March 24th, 2020. A little under 2 months ago. Headline: Goldman Sachs tells clients it's time to buy gold. Central bank emergency measures push traders towards currency of last resort. Gold continued to push higher on Tuesday as a recent wave of selling dried up, and Goldman Sachs told its clients the time has come to buy the currency of last resort. Like other asset classes, gold was hit hard in the recent scramble for US dollars, falling more than 12% from its early March peak of around $1,700 a troy ounce to $1,460 last week. The yellow metal started to see a resurgence on Monday, rising by more than 4%, after the Federal Reserve said it would buy unlimited amounts of government bonds, and the US dollar fell. It gained another 4% to $1,618 on Tuesday, helped by the recommendation from Goldman Sachs, which said gold was at an inflection point and could hit $1,800 over the next 12 months. The record high for gold is $1,900 reached in 2011. We have long argued that gold is the currency of last resort, acting as a hedge against currency debasement when policymakers act to accommodate shocks such as the one being experienced now, said Geoffrey Curry, head of commodities at the Wall Street Bank. As well as being seen as a hedge against all kinds of market volatility, gold is viewed by many investors as a way to protect themselves from the debasement of currencies and also inflation. It's just like in 2008 and 2009, when governments and central banks turned the printing presses on full speed, said John Ciampaglia, chief executive of Sprott Asset Management. Traders said gold had also been boosted by a weaker US dollar and other measures taken by the Fed, in particular the opening of swap lines with other central banks to boost the availability of dollars in the financial system. A weaker dollar is thought to be positive for gold because it lowers the cost of buying the metal for the holders of other currencies. The opening up of the swap lines, which may or may not curb the dollar's rally, has at least made the US currency more available, said James Steele, precious metal analyst at HSBC in New York. While interest rates were likely to be kept at close to zero, governments were likely to use fiscal policy to drive inflation back towards targets, said Jim Luke, a fund manager at Schroders, who views rising consumer prices as a positive for gold. Fiscal policy can take various forms, and we do not rule out direct helicopter money type interventions at all. As such, we could not imagine a more bullish environment for gold prices, he said. However, Nikki Shields, an analyst at Scotiabank, said investors needed to be wary because physical demand was likely to remain subdued with parts of India in lockdown. In addition, all sensitive emerging market central banks are likely to lower their pace of gold purchases. The strains caused by recent volatility in the gold markets were also evident on Tuesday, with the cash price of gold trading at $23 discount to the futures price on the COMEX exchange in New York. While there is no shortage of physical gold, traders said a lot of it was in the wrong location or the wrong form. The London Bullion Market Association said on Tuesday that there had been some impact on liquidity arising from price volatility in COMEX 100-ounce future contracts. LBMA has offered its support to CME Group to facilitate physical delivery in New York and is working closely with COMEX and other key stakeholders to ensure the efficient running of the global gold market, it said. End of article. It was a timely article, as gold has risen beyond the $1,700 since that article was published. But it was also around the time we recommended that silver was indeed a very attractive purchase because it had started to dip below $12, though because of ultra-high physical premiums, we suggested that it made sense to buy it via either ETFs or through houses or investment houses such as Bullion Vault, for example. Now, bringing us closer to date, we have seen, particularly the last few days, a greater concentration on gold with raised expectations. Let's take a look at a Reuters article published on Friday. Reuters article dated May 15th, that's Friday the 15th, at 4:50 p.m. Gold firms to over 7-year high as US-China tensions fuel economic worries. Gold jumped more than 1% on Friday to levels last seen in 2012, as renewed US-China trade tensions added to concerns about a deep economic slump due to the coronavirus pandemic. Gold rose 0.7% to $1,741.65 per ounce by 2:49 p.m. EDT, or 1847 GMT. During the session, it hit its highest level since November 2012 at $1,751.25. Bullion has risen over 2% so far this week. US gold futures settled 0.9% higher at $1,756.30, while subdued physical demand and central bank buying may have slowed its ascent. There's very little reason to sell gold in a time of unprecedented public largesse and deteriorating relations between the world's economic superpowers, said Tai Wong, head of base and precious metal derivatives trading at BMO. Underpinning the damage inflicted by the outbreak was the latest US retail sales data that showed a second straight month of record declines in April. Adding to the bleak economic scenario was renewed friction between the United States and China over the outbreak, with President Donald Trump suggesting he could even cut ties with Beijing. People are reluctant to take risk, and the future seems quite uncertain. Gold gives you that sense of protection right now because we're going into this period, said Phil Stribel, chief market strategist at Blue Line Futures in Chicago. The novel coronavirus, which has infected over 4.46 million people, and killed 301,445, has hammered global economic activity, prompting central banks and governments to unleash massive stimulus measures. Gold tends to benefit from economic stimulus because it is widely viewed as a hedge against inflation and currency debasement. Though many governments have started easing restrictions, the move has rekindled concerns of a second wave of infection. Given all of this chaos and confusion, it is hardly surprising that gold ETFs are seeing an unchanged high level of buying interest, analysts at Commerzbank said in a note. If speculators were now to jump on the bandwagon too, gold would quickly rise towards the $1,800 mark. SBDR Gold Trust Holdings, the world's largest gold-backed exchange-traded fund, jumped 1.2% to 1,104.72 tons on Thursday, its highest in more than 7 years. Elsewhere, palladium climbed 1.9% to $1,870.28 per ounce, but was on track to post its seventh straight weekly drop. Platinum rose 3.2% to $792.24 per ounce, having hit a high since March 13th at $796. And silver was 4.3% higher at $16.55. It touched a more than 2-month peak of $16.71 earlier. End of article. Yesterday, MarketWatch published a most interesting article, broadly entitled Billionaire Investors Recommends Gold. And this for us is now the start of the, perhaps what we would call the non-traditional gold investor community, beginning to look at precious metals as a serious alternative, if not a serious requirement, in view of what the economies of the world are likely to face moving ahead. Let's look at this article briefly. MarketWatch article published May 16th, 2020. The stock market may get cut in half, but this most undervalued asset is about to surge, Billionaire investor says. Paul Singer, the hedge fund billionaire behind Elliott Management, warned last month that the ultimate path of global stock markets is a drop of at least 50% from February highs. What's an investor to do in the face of such a grim outlook? Load up on gold, perhaps. After all, according to a report this week from the Financial Times, that's what the smart money is doing. Gold, advised Singer, is one of the most undervalued assets available, and it's worth multiples of its current price, due to the fanatical debasement of money by all of the world's central banks. His fund gained about 2%, the FT reported, thanks primarily to profits from its gold position. Andrew Law's Caxton Associates and Danny Young's Diamond Asia Capital have joined Singer in seeking protection in their gold positions amid further loosening monetary policy. Gold is a hedge against unfettered fiat currency printing, said Young, whose fund is up 36%. Caxton has also enjoyed double-digit gains, the FT reported, with its global fund rallying some 15% and its Marco fund logging a 17% jump so far this year. End of article. A picture, surely, is now beginning to develop. We noticed just a few minutes ago, as we were near the end of this publication, that Bloomberg today has produced another article on this very subject, and it's worth mentioning. It's supporting our theory further about the investment community. moving towards gold. Now, this article highlights that a number of hedge fund luminaries are now advocating gold as an investment. Let's take a look. Bloomberg article dated May 17th, 2020. Hedge fund luminaries are lining up behind gold again. Forget plunging oil prices and a collapse in consumer spending. Some of the world's most prominent investors are raising alarm bells over the looming threat of inflation and turning to gold for protection. Money printing by central banks and vast state stimulus packages are rekindling interest in one of the oldest stores of wealth. It's a revival of a trade that became popular in the wake of the 2008 crisis, as money managers piled into gold for similar reasons, but were ultimately disappointed as inflation was kept in check. Yet the unprecedented scale of government response to the coronavirus crisis is feeding the argument that this time will be different. Hedge fund luminaries, including Paul Singer, David Einhorn, and Crispin Odey, are among those bullish on gold, according to recent letters to investors. So are large asset managers like BlackRock Inc. and Newton Investment Management. Gold is the only escape from global monetizing, Odey wrote. Gold futures were the third largest position held by his flagship Odey European Inc. fund at the end of March. In the short term, the money will be made on the inflation bet. The logic is simple. The massive expansion of central bank balance sheets around the world must eventually dilute the value of their currencies, most importantly the dollar, leading to inflation of hard assets like gold. The price of the metal has already risen sharply this year, touching a 7-year high of $1,751.69 an ounce on Friday. But some believe it has much further to go. In recent months, gold has gone up in price to some degree, but we think that is one of the most undervalued investable assets existing today. Singer's Elliott Management Corp. Wrote in a letter to investors in April. He argued that low interest rates, mine disruptions, and fanatical debasement of money by all of the world's central banks would lead gold to rise to literally multiples of its current price. There's just one problem. It's a familiar investment thesis in the gold market, and last time it was tried in 2008, it fell flat. The most prominent gold champion back then, John Paulson, predicted massive inflation and bet on gold as the only asset that will hold value, according to the 2009 book, The Greatest Trade Ever. While the bet was initially a profitable one, gold rose to a record of $1,921.17 in 2011. The high inflation Paulson predicted never materialized, and the gold market fell into a multi-year slump that weighed on his fund's performance. Today, the gold market faces a similar debate. Despite the warnings, market measures of investor expectations are pointing towards lower inflation as the world undergoes one of the sharpest economic downturns in history. The US five-year break-even, a measure of medium-term inflation expectations, has fallen from around 1.8% at the start of the year to 1.4% now. The speed of money transmission has slowed down so much, says Darwai Kung, head of commodities and portfolio management at DWS Group. Without that changing, it doesn't really tell us we're going to have a high inflationary scenario coming back. Those betting on gold argue that there are key differences between now and 2008. First, governments have responded to the coronavirus shock with larger stimulus measures and show greater readiness to build up debt levels. We expect policymakers to target and applaud mid-single-digit inflation, which, combined with interest rate suppression, will be the only way to outgrow the mounting debts, Einhorn's Greenlight Capital argued in a letter to investors. It's almost inevitable that there will be a fiscal tailwind for gold when markets wake up to the scale of the stimulus, agrees Catherine Doyle at Newton Investment Management. Second, the current economic crisis is not just hitting demand for goods and services, but also supply. Businesses have shut down, and in the longer term, the crisis may push companies to redraw supply chains. Even if hyperinflation isn't around the corner, the costs of holding gold are relatively low in the current economic environment. Russ Kusterreich, portfolio management of the $20.5 billion BlackRock Global Allocation Fund, points to gold's inverse relationship with real interest rates. When interest rates adjusted for inflation are low, the opportunity cost of holding gold is similarly low. Currently, real rates are negative. That means even if inflation doesn't accelerate, the prospect of policy interest rates near zero or even negative for the foreseeable future should boost the metal's appeal. In an environment in which bond yields are close to zero and decidedly negative after inflation, there is no opportunity cost to holding gold. Historically, this is when gold has performed the best, says Kusterreich, who has been increasing his gold exposure. And just as in 2008, the arrival of high-profile backers may continue to buoy the gold market. Exchange-traded funds tracking the precious metal have seen the biggest dollar inflows on record in the first 5 months of the year. The people that were expecting QE to result in much higher gold prices in 2008 are now saying, "My God," said John Reed, chief market strategist at the World Gold Council and a former partner at Paulson & Co. The key is, does that view become more widely held? End of article. So what we are witnessing are serious tranches of the investment community, including major banks, now advocating gold for its clients to consider. Of course, this does not mean that overnight we shall see gold rise to $5,000 or $10,000 as the pumpers would have you believe. But what it will do is cause gold to continue on its upward trajectory, with some days providing gains of a couple of percent, as we saw Friday, and then days of some pullbacks, and then additional gains and more pullbacks, etc., etc. This, from an investment point of view, though, is what those like us who've been involved in this community, investment community, for 30 to 40 years actually want to see. It tells us that these investments are gradually moving out of weak hands into stronger hands, and this gradual build-up of confidence will result in continuing higher prices. Now, for gold and silver to peak, or perhaps enter bubble territory, may take anything from 2, 3 to 5 years. With huge levels of unemployment and devastation of people's income, we're not likely to see the fanaticism that perhaps was witnessed in 2011 of the ordinary man in the street flocking to buy gold and silver. But what we are more likely to see over time is more serious investment funds delving into this area. And this will have a slower but much bigger move over time. And for those holding precious metals, we just now have to be patient and let economic nature take its course. Thank you so much for listening. If you haven't already done so, please subscribe to this channel and press the bell sign so that you're notified of our videos as and when they are published. Not forgetting, of course, to pop over to our Richard and Greg channel, which we update every few days. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.